saving, inflation. What is the story that we want to tell today?
We always talk about the financial markets.
Every time.
Normally we talk about sectors and about stocks. Today we're going to talk about another product. Maybe it is a little bit boring, but it's so important nowadays. We are going to talk about bonds.
Yeah.
If you have some money, cash, on a bank account, and you don't invest it or you don't put it in a product, then you're losing money.
Yeah.
And we start with the most safest way to invest in the world, and that's investing in AAA bonds. What is a AAA bond? It's the most safest way, and in practice it's always a government bond, and it's, for example, from France or the Netherlands.
Correct.
Two big advantages when you invest in certain bond compared when you put it on a saving account. A saving account maybe get you 1% of around, maybe a little bit more. In this case you get more, and it's safer, because if your bank goes bankrupt, and of course that's a small chance, then you lose your money. Of course there are guarantee funds, but those funds cover up until a certain amount, and only when there is money in the market.
Correct.
So first you want to say a little disclaimer today, what we don't do normally.
No, we do not. Yeah, we don't know do it because we are talking more generic. But we're going to give 4 clear examples, and we're pretty enthusiastic about it. But it doesn't mean that you have to go and buy them directly. So everything that we're going to tell is not individual investment advice. It's meant to inspire you. We picked 4 bonds in our platform. We can find over 20,000 of these things. So please, as an inspiry, so you understand how it works. And then you can go and look for it for yourself.
And we start with the most safest way.
And we build it up.
And we build it up a
So
little bit.
Don't skip.
No.
Don't go to your next video. Watch until the end, because
in this case, no, we never say it. But in this case, you should finish until the end.
if you're typical vloggers now, but it is. They always say no, but in the end, I'm going to show you something which is really nice. In this case,
we build it up.
We are going to show you
a little bit more risk, but also more interest.
Absolutely.
I started with the savings one, Dutch bond. You can buy it on the stock market. It expires in July next year, so it is 9 months, no?
Yeah,
9 months, July next year. Do you have to wait until July next year? No, you can. It's Friday morning for us. If you buy it at 12 o'clock, you can sell it 5 minutes or a second later. And those products are really liquid, so the prices that you get are really good. So you only lose a little bit of spread.
Yeah.
If you lose. You don't need to lose, but so you don't have to wait. And that's also a big advantage compared to products where you have to hold your money for a certain time.
Correct.
AAA, Dutch government, until July has a coupon of 2%. But you can buy it for less than 100. You can buy it for 98.8%. They give you back, the Dutch government, in July 100. So you have first of all, you have a 2% coupon, and you earn money because you earn 120. Percentage-wise, we calculated, Martin did the calculation for you, you get 3.6%.
Yeah, and that's funny because how is that possible? 1.2 to 100 and 2 is 3.2, but you have to always calculate it back on a 12-month period. And what is your initial or your average investment? So, and that becomes clear if we go to the next example.
Yeah, but I wanted to say something.
Oh, you're not finished yet?
No,
sorry.
3.6%. If you sell it, for example, in 1 month, then you get also part of the interest.
Yeah,
1 month of interest. So it's not like that you have to wait until the end. You can sell it in between. You have to wait until the end. Then you get the interest. No, every day you build up the interest.
Exactly. And also when you cancel a deposit, for instance, you don't get anything.
And why does your bank doesn't say that to you? Because if everybody does this, they don't have any more the cash on the on a balance sheet. Then they need that for their ratios.
Yeah. And banks are not going to
okay, that is it now?
Banks are not going to like it, what we're just telling here.
No, but that was it. Okay, we go on. If you want to have more interest.
Yeah. So if you want to have more interest and you have money that you don't need for the next about 10 years or something.
But you can always sell it.
You can always sell it, yeah, of course. But what I'm going to show you something here, which also has the possibility that will grow in value because of the fact that if the interest rates go down, this bond will go up in price. It's from Spain. It's in a bond that runs until October 2033, so about 9 years, 10 years. And you're buying it for 96.63. So you know you're buying it again under par. You're buying it for less than 100. You know you're going to get back 100, so you have what they call redemption profit. The profit will be 3.37% until those years. That you divide by 8, and then you look at the average investment, buying it for 96, get 100 back, so that will be 98.31 is your average investment. You calculate then the redemption profit plus the coupon, and you divide those by the average investment, and you get a average effective yield of 4.1%. But you might say, well, I'm going to buy this now, because if I invest in the Dutch government in 1 year, I make 3.6. You can see by this example that the market, who's a market, that's all the investors basically, they have an estimation that the interest rates will go down a little bit, because otherwise they would require from Spain that they pay much more interest. And that's funny, because it's only 4.1. This bond had a price
only for related to the 3.6.
3.6.
Still much more than.
It's much more than, and Spain, for information, Netherlands with Casper Collins was AAA. This one is A. So Spain has pretty high rating. Of course, we know from Spain they have a pretty high government debt.
And if the interest rates go down, the value of this bond goes up.
Yeah, so the 96.63
the other way around is also the case.
Will go, for instance, like if you look at the chart, you see that it was a lot higher about a year and a half ago.
So that were the government
That
bonds.
was the government.
Now
we go
corporate
to
bonds.
Corporate bonds. The first one, and Casper's going to close off. The first one I want to touch on is, I'm staying in the south of Europe. I prefer that towards the north of Europe. Is a Italian telecom company, Telecom Italia. And you might think, oh, that's scary and stuff. This is a big company. It's a billion company. It has it's also listed.
What is the rating?
The rating is BBB, and that means that it has a stable outlook. So there's no expectations by Moody, Fitch, or what's the other one? S&P, that there will be some rumors in the future that cause them entering in a default. That can change, of course, by anything, but at this moment, the outlook is stable. Bond runs until 2030, more or less, 6.3 years remaining maturity. The coupon is 7.75%, and you're buying it at 105.70%. So
in this case, you lose
money. You're buying something which you know you will lose money on. Of course, if you don't have the possibility to keep your money in this bond for 3, 4, 5 years, you have to reconsider. This is not interesting for you. In this case, average investment, because you're buying at 105, redemption at 100, will be 102.85. You have some redemption loss in this case, so your coupon, your real coupon is not 7.75, but 6.85. So the effective yield on this bond until it ends, until it redeems, is 6.6%. Not bad for a really big multinational billion worth company, I think.
Definitely.
6.6%.
Last one.
And you're not going to know it, but we're from the Netherlands, and in the Netherlands, everybody knows this thing. It is called the Rabobank, no?
Well, we have also a lot of viewers on our English vlog that are Dutch.
Are they?
Yeah.
Oh, I didn't know that.
It's not exactly a bond. It's almost a bond. It expires in 2099.
Mm-hmm.
So you can say it's a never ending. It's a perpetual. So we don't calculate with the date in 73 years that it expires. So we only look, okay, what do I pay for it, and what is the coupon? This one gives in a coupon of 6.5% minimum. There are also calculations depending on the interest rates in the market that it can be higher, but a minimum of 6.5%. At the moment it gives 6.5%. It pays out 4 times a year. It's also quite interesting for your cash flow, of course. And it's now trading Friday morning around 92. And if you calculate 6.5 back to 92, then you have an effective yield of 7.1%. 7.1%. If something happens in the market regarding interest rates, this bond has a much more that has a much more effect on this bond. You can look the chart back, then you see that I think 1.5 years ago it was trading 140.
Yeah.
Again, it's now trading at 92. So if the interest rates go down in the market, this goes up in price.
Yeah.
And you saw that this morning, the inflation figures came out. They were quite positive. So they think there won't be an increasement in interest rates. So the value of this bond went up.
Mm-hmm.
And this is the second largest bank of the Netherlands. So really interesting. And what we want to say, if you invest in bonds, don't buy one bond,
No.
but make a basket. So say I want to, for example, 50% of my money in the really safe ones, the AA and the AAA, and then you make a duration separation,
Yeah.
a short one,
Shorter ones,
a
longer
longer one,
ones.
and then you can build it up.
Yeah.
And to close off, I think what we said, we don't understand that people keep cash on an account or looking for a 1.5% interest rates. If you can have, the first example, most safer, because you always get your money back, AAA, Dutch government, July next year, effectively yield 3.6%, and you can sell it every day, and then you have the interest related to the period you had it in your portfolio
Exactly.
on your account.
Up to you. See you next week.
Give us your time, please. Thank you for watching.